Thank you, Christian. Thank you for organizing the conference, and it's great to see everyone. I know most of the people in the room, but those who don't know me, I am portfolio manager at Firebird Management. We're best known for investing in Eastern Europe. We've been doing that since 1994, so for almost 30 years at this point. We also have a US strategy, but today, definitely more interesting subject is Eastern Europe, so I'm going to focus on that. Firebird started out investing in Russian voucher privatization. Russia was still an important part of investment universe for us up until last year. It remains an important part of investment universe in Eastern Europe, and it influences everything that's happening within the region. And that's part of the, part of where the opportunities are coming from as well. The thing that Firebird did differently from the beginning is that we started looking at other countries in the region, not just Russia, but we started looking at countries more on the frontier, countries like Kazakhstan, like Georgia, Baltic countries, Romania, and we were one of the first investors in those places, which gave us a competitive advantage as those countries have developed over time into more investable markets. But in times like today, you will have to ask yourself a question: why do you invest in Eastern Europe in the first place? There's wars, there's corruption, etc. But there's also something else that we all value investors look for that we think that exists in Eastern Europe more so than in many of the other markets that we've looked at. And it's the combination of quality, value, and growth that you don't really see anywhere else in the world. From a quality point of view, what we have is we have high quality companies. Sometimes the quality comes, competitive advantage comes from the world-class natural resources. Sometimes competitive advantage comes from companies operating in highly competitive environment over the period of 20 to 30 years and emerging winners from that environment. In emerging market, everything is compressed from a point of view because of the competition that comes, because of the new challenges that are there. So the companies that survive that and benefit from that are usually doing really well at the end, and they have the opportunities to dominate the local markets. From a growth perspective, the countries that we are investing in usually have a growth rate of 3 to 5% real GDP growth. Nominal growth is usually quite a bit higher because of the inflation. That's the reality of our market, and it's been that way for a long time. So as a result, we're investing in places where the natural growth rate is quite a bit higher than what we're seeing in Western Europe or even in the United States. And from a value perspective, and I'll talk about it a bit more later, the world that we're operating in usually trades at single-digit P's. It was doing that even before the war started, and the valuations that we're looking at within the region have compressed even further in the last 12 months. But that's all theoretical. The reality is there's a war. And Russia attacked Ukraine February 24th, 2022. So the question is, what happened? Obviously, it's completely separate in conversation in terms of Russia and Ukraine. I'd rather not get into it right now because we're going to lose point of everything else. But the part that I want to look at is what is happening elsewhere in Eastern Europe while this war is going on. And I would argue that Eastern Europe has become a better investment destination over the last 12 months and not worse. One reason for it is that Russia is weaker, as we can see from what's happening on the ground, but also NATO is stronger, and countries like the Baltic countries, Romania, they're part of NATO. And NATO has become something that when Trump was president of the United States, it was an entity that was everyone was trying to figure out what is the purpose of it. And there's no questions like that today. Everybody understands what's the purpose of NATO and why it has to be around. The countries that we're investing in have been wary of Russia for a long time because of the relationships that they had historically. So as a result, they've been orienting themselves away from Russia, both from a natural resource dependency, but also from a trade dependency. So we are investing in the regions that did not have to change that much from a point of view of what they were doing in the last 12 months, and that's helping them. That said, because they depend on places like Western Europe, they are reliant on what is happening in Western Europe, so that's something that we're wary of. You also had, because of the war, you had huge migration that happened both from Ukraine, where 5 million people are leaving, left the country. A lot of those have settled in Western Europe in places like Poland that has taken on over 1 million people, places like Germany. But also you see some migration to other places in Eastern Europe, in places like Kazakhstan and Georgia. And you also have people going from Russia that are avoiding the war because the government is becoming even more restrictive, because there's a real chance of being drafted if you're male under the age of 60. which different story. And so 900,000 people left Russia trying to avoid that conflict. And many of those have settled in places like Georgia, which have taken in 4% of the population within a period of a year. It's a significant number. And now about valuations. We started out from average valuation of places that we're investing in around 8, 9 PE. Right now we're closer to 6. We've had investments that have corrected by about 30 to 40% after the war has started. The results of the companies have improved, but the multiples have not changed since what we've seen in last March. Meanwhile, economically, things are fine. We see GDP growth in Georgia, and I'm going to talk about it a lot more later, of 10% last year. Places like Romania and Kazakhstan are delivering very strong GDP growth in a very complicated environment last year. The company I want to talk today about is Bank of Georgia, and I was presenting in this conference, if I remember correctly, 6 years ago, talking about a different bank, Sberbank, which was great up until it got sanctioned. But part of the presentation that I had was presenting a framework in terms of how we're looking at Eastern European banks and why we're finding value there. And the metrics that we were looking at, it was in terms of growth, that was from a point of view of the GDP growth, and so the operating environment. The quality that had to do with asset quality and also efficiency, and that's the cost income measure. And then also the valuations that we're paying for it. So the other companies, not Sberbank, but the other companies that I was talking about at the time, I went back to take a look what actually happened to them over the last 6 years. You have to be, reflective. And what I saw is that, first of all, from a macro environment, things got better. You have faster growth over the last 6 years compared to the 10 years before that, which were already pretty good. And this is in nominal terms. From the efficiency perspective, the banks did what we thought they were going to do. They became more efficient across the board. The cost-to-income ratios that you see on the slide, in terms of 20, 30, 40%, this is an envy of any Western European bank. Usually it's 60 to 70%. Those cost efficiencies are driving high profitability. We've seen ROEs across the board of at least high teens, sometimes 20%, sometimes 30%. And this is something that the banks have delivered consistently. We actually got positive returns from all of these investments of nothing out of the ordinary, but 5 to 13% in dollar terms, which if we're talking about the last 5 years was okay. But the most interesting thing that happened is that we went from companies that were already pretty cheap 6 years ago. And this is the measure in the middle in valuation. This is a measure of return equity plus the growth that has been delivered in the recent years, divided by price to book that you're paying for it. This is an approximate proxy of how we're looking at the valuations. So they went from being cheap to ridiculously cheap, while delivering positive returns to us as investors. So if we're looking out for the next 5 years, we're pretty excited about what we have in the portfolio. I mentioned Georgia a couple of times by now, so I'm going to dive a little deeper. It's a country of 3.7 million people, and the most interesting thing about it is the geography, because it's kind of square right in the middle between Central Asia, Middle East, and Eastern Europe, and that position is becoming more important today. Historically, they've been doing pretty well as a transit hub because most of their neighbors hate each other. Armenians and Turks don't really talk to each other directly, but their business people are happy to do business through a place nearby, and that place is Georgia. So what you saw is that you had a fairly healthy economy being developed, both because of the domestic consumer growth, but also because of where it was located. That location became more important in the last year. You see trade flows being channeled around Russia. Natural place for it to happen is through Georgia. You have energy flows being channeled around Russia. There's a pipeline going from Azerbaijan to the Caspian Sea, to the Black Sea, and it goes through Georgia, and that pipeline has been losing volume because Azerbaijan, as an oil producing country, has been losing volume. Now Kazakhstan is going to be sending additional volume through this pipeline, once again, which is a boost for Georgia, which is a boost for the region, and kind of explains to you the importance of the country. Very good place to do business. This has been a constant pretty much for the last 20 years at this point. Georgia had a very turbulent history. early post-Soviet period, this was not a good place to be. You're talking about the country that had the reputation for probably being the worst corrupt place in all the former Soviet Union, and that's saying something. They had a civil war. They had a succession of pretty bad governments, and all of that has led to election of Mikhail Saakashvili, who came in with a mandate to change the country, and he did. He changed the country. The first thing that he did is that he fired every single policeman in the country, saying, and this, because this was one of the parts of the endemic corruption in the country, and he saw that in order to truly make people believe that this is changing, you have to change something that people interact with on a daily basis, which is police. So he fired every single one and said, you can reapply for your job, but this is the rules under which you're going to operate. If you go to Georgia today, the police stations are made out of glass. The reason for it is because policemen know that people are watching them, not the other way around. It's quite amazing. But the most important thing that he did is that in 2012, but he was autocratic. Not a lot, people liked what he was doing, didn't really like the style. There was a lot of things to push through. There was some disregard for rule of law, but he needed to change the country. But this is a democratic country, and in elections in 2012, when he lost the election, despite being a relatively autocratic leader, the most important thing he did to establish the Georgia that we see today is to say, I lost, I am leaving. And that's where we are today. And since then, the parties that has been in power has been taking a more pragmatic approach. And there's reasons for it, because in 2008, you had Russia attacking Georgia, taking pieces of the territory that were kind of autonomous regions to start with, but kind of under Georgian control before. Now they're more under Russian control. So the government that has stepped in has to balance Russia, has to balance Western Europe, and it's a very difficult position that they find themselves in. And meanwhile, the view that we're seeing from the West is the headlines in terms of the backsliding that they're doing vis-a-vis European reforms. You see, there was, I'm sure a lot of you have seen the news about this law that they were trying to pass. There was a kind of foreign agent bill that was kind of seen as mimicking what Russia is doing, ignoring the fact that the US has the same laws on the books, but that's a different stories. And that there were protests. This law was taken back. But the government that is trying to do a very fine balance of managing all of these different interests that are coming in from the outside, this is happening within a normal democratic process. This is a country that has established normal democratic relationships. And what's happening there is turbulent, but I would argue is normal. But what's more important is that from a point of view of business, running a business, and I was there 2 months ago talking to companies to find out what is happening. What they're saying overwhelmingly is that from a point of view of how you're doing business in the country, that has not changed dramatically over the last 5-10 years under the people who are in power right now. So then that's what we're looking at from an investment point of view, because the rest of it is really noise. Georgian banking system, I'm going to talk about Bank of Georgia today, but you have to start at kind of the big picture in terms of the operating environment. And this is probably one of the better operating environments you can have as a bank, because what you have is you have a very disciplined duopoly of 2 banks that each one has roughly 40% market share, that compete with each other based on product quality, but not on price. So what they're trying to do is they're trying to offer the best product for the customers, which is great as a customer. But if you want to get a loan, it's not going to be cheap. And if you go across the street to the other bank, you're going to get the same price. And meanwhile, the smaller banks, because these guys have scale, the scale that they have, the smaller banks simply cannot compete. So what you're seeing is these 2 banks becoming slightly bigger as opposed to slightly smaller over the years, while delivering very strong ROEs of 20, 25, 30% with strong net interest margins and low cost income ratios. The potential competition from fintechs, which is a concern in a lot of other places where you have strong banks, I would argue is less of a concern here because, as you can see in the top right, Georgian language is weird. And there's only 4 million people or so that read it. So for you, if you're Revolut or pick another one of your favorites, fintechs, for you to develop applications specifically for this market, there's no point. The addressable market is so small. And meanwhile, from a product quality point of view, what these banks are doing is they're delivering the features that the customers are looking for within the applications that they have. So I would argue that the operating environment is pretty good. Bank of Georgia is listed in London. Part of the reason why it's listed in London is because Georgian Stock Exchange doesn't really exist. It's a company with 1.2 billion market cap and 3 million daily trading. So it's good enough for us. It's too small for a lot of other institutional investors, but that's kind of part of where the opportunity is coming from. It's one of the 2 large banks in Georgia. We like this one a little more than the other one, which is TBC. We think they have better management, but reality is both of these companies are very profitable and very good. The business model for Bank of Georgia, and that's an important point, is designed around delivering 20% returns on equity. They price everything off of 20% return on equity, and then they usually deliver something that is a little better because they're conservative in terms of how things are done. Loan book has been growing at 18% per year. Most of it is, as you saw, their market share has increased a little bit, so this is essentially market growth. The reason why you see such high market growth is high GDP growth, plus the fairly low banking assets to GDP ratio, which is, so they have a good starting point, so there's this conversion process that's happening. So this growth of 18% per year, it's probably hard to sustain that, something that they've been doing over the last decade, but 10 to 15% per year is something that they can do definitely for at least another 5 years or so. And the business model I mentioned is designed to deliver ROEs of 20% plus, and they've been doing so for the last few years. We've been involved in this company since 2004, if I remember correctly, but we like it even more in recent few years. And part of the reasons why we do that is because of the new CEO that came in 2019, Archil Gachichiladze. And he has come in with the idea that, okay, we're starting out from a fairly strong competitive position, but we need to make sure that our customers like us. So what he wanted to do, and because that's the bank's Achilles heel, and that what he wanted to do is he wanted to improve the customer relationships, and he's doing that through digitalization. So giving the customers a much better experience. Since he has came in, the NPS score has almost doubled, and I haven't seen a lot of places where 60% of the customers are recommending their banks to somebody else. It's quite unique. But part of the reason why he's doing that is because it's not just good to retain the customers, it's also good for the company financials. The cost-income ratio has been coming down as a result of this digitalization process, because the people who are working there are becoming more efficient, more productive. So that's why you see the cost-income ratio coming down. One thing that has been consistent throughout our years of knowing the company and being invested in this company is that they've always been very good at capital allocation. And when the company was growing at 20% per year while delivering 20% ROEs, there wasn't a lot of free capital. While there was a lot of growth, there wasn't a lot of free capital. The growth has been coming down a bit, while profitability has been going up a bit. So as a result of that dynamic, what the company has been doing recently is that has been generating excess capital, and that excess capital is being paid out to shareholders in the form of dividends and buybacks. And there's been a few comments on dividends within the presentations that we heard earlier. Theoretically, I totally agree with that. Dividend is just like a buyback, but it's less capital efficient. But from a point of view of discipline on management, the dividends and having a capital distribution policy that includes dividends, we find that it usually helps in places like Eastern Europe because that puts a certain discipline on them. So we like seeing dividends. And in this case, the dividend that we're getting is about 10% on last year's results. And that comes in addition to the share buyback that's happening the company has bought back 3.5% shares outstanding in the last 6 months. So the metrics that I introduced 6 years ago and wanted to make sure that this is still consistent with Bank of Georgia is that what we're looking for growth. And I would argue that the GDP growth, because of the GDP growth, we should be able to see 5% plus growth in GDP and significant growth in loan growth for this company. This company has very good funding, so the problems, and I can talk separately about Silicon Valley and comparing Eastern European banks to that, but the loan to deposit ratio for this company is very good, meaning that most of the deposits that have come in have been lent out in loans at high interest rates, not at 2%, not at 3%, but like 12, which is very different. And a lot of those loans are floating, not fixed. It's efficient. It's not expensive. So the chart that you see on the bottom here is, I compared the price, so the price at where it trades to the PE ratio, which is the blue line. And this bank was not necessarily expensive before at 7 PE, given the quality of the company that we're seeing. But right now we're kind of reaching ridiculous levels of 2.5, 3 times. The expected IRR on this, I have no idea. But I know it's cheap, and I know it's good, and in the past, something like this has been worked out really well for us and for our investors. I could summarize, but this is pretty much, we like Eastern Europe because of the quality, value, and growth. We like Georgia because it has some of the best examples of that and is a bit misunderstood because of the headlines that we're seeing. We like the Georgian banking industry, and we really like Bank of Georgia. Thank you so much.
Any questions?
Management focus. So TBC is the other bank, and Bank of Georgia is focused on Georgia. They have this Belarusian subsidiary that they bought many, many years ago that does not require any management time or capital, but they're focused on Georgia. TBC is focused on expanding to places like Uzbekistan. They spend a lot of time talking about Uzbekistan, while the clear opportunity and where they have a competitive advantage is Georgia. And I would also argue that from a management quality point of view, Bank of Georgia management has always done a good job of saying, here's our strategy, here's why. And TBC, unfortunately, has a little bit more of a follower mentality to it, because you've seen in the past where they have, there will be situations where their loss ratios would be going up. And the market would say, and the market participants would say, guys, your loss ratios are going up. This is a problem. They say, oh, don't worry, we'll fix it. So they start giving out less loans, and loss ratios goes down. And then the market starts complaining about the growth rate, and they go to that. And so like that, what we saw is that management being a bit more reactive, where Bank of Georgia has always had a clear strategy of what they like, why they like it, and they've delivered.
Do you think TBC has a better tech platform?
From what I can tell, it's similar at this point. So they had a better tech platform 5 years ago, but under new CEO, that was a key focus for him to fix that.
Okay, and then how would you compare this to, say, Halak, for example?
Halak? Halak, I mean, we're talking, while the both dominant banks within their countries, the macro is different. The risks are slightly different. With Halak, the big question, I mean, I love Halak, don't get me wrong. But there is uncertainty with Halak in terms of what's happening with the ownership and where the main owner of Halak stands vis-a-vis the existing, with the new government that's in place. They're probably okay, but this is a risk that does not exist in Bank of Georgia. There's other risks that exist in Bank of Georgia, but they're both phenomenal. We own both.
Okay, one more question, if I may. In terms of the influx into Georgia of young, mobile, wealthy Russians, which has really made the economy boom,
yep.
A lot of people say, they're not going to stay there, they're going to go elsewhere. Do you have a view on that?
So in terms of the influx, from a point of view of the impact on Georgian economy, that was definitely helpful last year, and that's one of the reasons why the currency has done really well. If from a bank point of view, they say that they probably had excess profits of about 20% last year. So the profits last year pretty much doubled. And they attribute about 20% of that to all of these people coming in from Russia and Ukraine, and they're saying, okay, this is not normal. We expect it to normalize somehow. 100,000 people gonna stay? No. Is it gonna be 10,000 people or 20,000 people that are gonna stay when things normalize? Or 40 or 50, I have no idea. But what's more important is this trade flows, and that is permanent changes in terms of what is happening to trade flows in the region and how important Georgia is there.
Thanks.
what's the ownership of Bank of Georgia, and what is the background of the current top management?
The ownership is fairly diversified. So this is it's also unique for Eastern Europe in a way that it's mostly owned by funds like ours, and funds. So there's no controlling shareholder. Management, I don't have the number in top of it, but I think management owns about 10% of the bank in total. So they do have skin in the game, and they get compensated via shares. The background of the management is mostly, so what happened in 2012, in 2004, is that when Saakashvili came into power, he put out a call to all of the Georgians that left over the previous 15 years because of how horrible it was, and said, I'm going to build a new country, and I need your help to do that. So bankers from London, bankers from US have come back to help him and stayed there. And I don't know how many of you have been to Georgia, but I strongly encourage you to go. It is a beautiful country to visit. I mean, extremely friendly. So you can see that if somebody who is passionate about making your country better, that is competent, you will come back and you do that. So this is the management that we see in place there right now, is those people that have Western experience, Western educated, that have come back to make the country better. Who? Okay, so he is being starved in jail. This is awful, but he is purposeful. So he came back to Georgia because he's only been relevant in Georgia. He likes popularity. And he was put in jail because he was told, if you're going to come back, you're going to be put in jail. Whether it's correct or not, that's a different story. And when he went to jail, he became irrelevant again. So he's trying to get out of jail by hunger strike.
So it's not being voted. Who knows? But why was he put in jail in the first place?
Well, part of the reason why he had to leave the country after he lost the elections is because they were accusations of people in his government of mistreating prisoners, or mistreating a lot of people. So there were charges related to that he escaped. Whether they're correct or not, that's a different story. We're not loving that part. But there were real charges in real courts against him, and that's why he's in jail.
What would you say is a risk that with these issues with Russia that might get out of control at some point? Because they are not Ukraine, obviously, and perhaps Russia with a few divisions might turn them over.
I would argue that they're lower now than they were a year ago, in part because of how weak Russia is. In part because what you see in Ukraine, and what you would see in Georgia as well, is that you do not get this quick victory. I mean, you may take the territory, but then you get hell in terms of what happens there. And that was the mistake that Russia made, not realizing that. And I know they wouldn't make that mistake, even if they had the manpower to do that. So the risk was there, the risk is there. I can't put a percentage on it, but the benefit that Russia would get out of it is negative, not positive.
Anybody else?
It was related to Christian's question. When you see these low Ps on some of these very small markets, how much is it's a country risk premium? How much do you have to take into account that you're investing somewhere where the variability of outcomes is much greater than what we expect?
The easy answer is all of it, but I know it's an easy answer. But the reality is that we think that the reason why you see these multiples there, and this is kind of an inverse of what you're talking about, is that you don't have a lot of investors that are willing to step in from the West for two reasons. One is that if you buy something in Kazakhstan and Georgia and you're wrong, and you have to explain to your investment committee why you did that, there's just no benefit. And second is that there's very little. We're talking about fairly small countries and fairly small companies. 3 million daily trading volume for most professional investors is just not plausible. So what you have is kind of orphaned stocks from a point of view of investment, and that's why you saw multiples come down, down, and down. But they cannot, they could go to zero, I guess, but there's very little that can be left. And the marginal buyer, more often than not, has a higher cost of capital than a Western institution. So that explains the lower valuation, but it also explains, like, people asking me, what would you want for the stock to happen? I say, I want the multiple not to change. Because if the multiple doesn't change, at these prices, I'm making 30% per year. If the multiple doubles, then I have to think of what to do with the money. If the multiple halves, I'm not making money. So I want things to stay the same for my investors to do great over long term. Our average holding period is 8 years. We've owned this since 2004. We're happy to own it for the next 15 years.
Just a simple question. What do you think is the bigger risk in this investment?
That's a great question, and I think what it is, it's macro. It's macro. It's Russia, as Christian was bringing up. So it's Russia doing something irrational. It's also the government stepping out of line. You think it's a risk? I don't think it's a significant risk, because what you see them responding to normal democratic process. But it is a risk. But from point of view of economy, it's a very well-run economy that's doing really well.
Okay. Thank you very much.
Thank you.